When you leave a job to go self-employed, nobody hands you a memo explaining that the tax rules just flipped completely. A new sole trader earning $90,000 who forgets to set money aside can owe over $23,000 in one lump sum at their first tax return with no employer withholding to soften the blow. Today, I will walk you through exactly how to avoid that shock and stop quietly falling behind on super. Here is why this catches people off guard so badly. As an employee, your tax is drip-fed out of every pay through PAYG withholding, so you barely notice it. According to ATO schedules for 2025-26, a sole trader on $90,000 faces around $20,000 in income tax plus a 2% Medicare levy of $1,800. And because nothing was withheld during the year, the entire bill of about $22,000 lands in one hit. Your very first move is to create a dedicated tax account, separate from your everyday business account. From your very first invoice, automatically move 25 to 30% of every client payment into that account and treat it as untouchable. The ATO expects self-employed people to plan for tax during the year, so this simple habit means the money is already waiting when your assessment arrives instead of vanishing into living expenses. Next, log into MyGov and open ATO online services under your sole trader account. Check your last year's tax assessment to see your real effective tax rate on business income, then opt into PAYG installments if the ATO offers it. This spreads your tax across quarterly payments instead of one brutal lump sum. And it protects you from the general interest charge, which the ATO publishes quarterly and which often runs around 8 to 10% per year on unpaid amounts. Now to the second silent trap. From the 1st of July 2025, the super guarantee rate permanently rose to 12%, meaning employers must pay 12% of an employee's ordinary earnings into super by law, according to the ATO. But as a sole trader, you are excluded from that, so unless you act, you are missing the equivalent of a 12% pay rise into your retirement every single year. Step 3 is to pay yourself super like an employer would. Calculate 12% of your expected annual income, so on $90,000 that is $10,800 a year, and set up a monthly BPay or direct debit of around $900 into your existing super fund. Doing nothing has a real cost because the ATO confirms an employee on that income receives $10,800 a year, which over 30 years and a conservative 5% return could grow to roughly $720,000 by age 65. Step 4 is the one people forget, and it costs them dearly. After contributing, you must submit your fund's notice of intent to claim a deduction for personal super contributions before you lodge your tax return. If you skip this, the ATO treats the money as a non-concessional contribution, and you lose both the tax deduction and the lower 15% contributions tax. Inside the fund, your contribution is taxed at just 15%, far below a middle earner's marginal rate of 32.5% or higher. Let me show you why this is worth the paperwork. If you contribute $10,000 and lodge that notice, your fund pays 15% contributions tax, which is $1,500, but your assessable income drops by $10,000, saving you roughly $3,350 in income tax at around a 32.5% to 34.5% rate, including Medicare leaving you about $1,800 ahead immediately, plus all the future investment growth. Your final step is to audit your caps so a good deed does not turn into a penalty. In ATO online services under the super section, confirm your concessional contributions stay at or under $30,000 and your non-concessional under $120,000 for the year. Breaching either can attract tax of up to 47% on the excess according to ATO rules, which wipes out nearly half the benefit, so check your fund statements before making any large top-up. Before we wrap, here are the mistakes that hurt the most. The first is treating business income like a salary and spending the tax portion, which leaves you exposed to the general interest charge of around 8 to 10% a year if you cannot pay. The second is assuming super is optional until your business is bigger, when in reality skipping it for decades can leave you hundreds of thousands of dollars behind an employee on the same income. according to ATO and super contribution figures for 2025-26. To put the stakes in real terms, consider a freelancer earning $90,000 who never pays herself super from age 32 to 65. Missing $10,800 a year for 33 years, with her starting balance growing at 5%, leaves her roughly $635,000 behind an employee on identical income. Most of that loss is completely silent because she never sees the missed contributions, only a smaller balance at the end. Let us run the checklist one more time so it sticks. Move 25 to 30% of every payment into a separate tax account and opt into PAYG installments through MyGov so tax never lands as a single shock. Pay yourself 12% super monthly. Lodge the notice of intent before your tax return to claim the deduction. And finally, check your caps. Stay under 30,000 concessional and 120,000 non-concessional. If this saved you from a nasty surprise, hit subscribe so you catch every plain English money guide we release. Next up, I am breaking down exactly which business expenses you can legally claim as a sole trader to shrink that tax bill even further. Set up your tax account today because the best time to start is with your very next invoice.